Hello friends, this is Vijay Bhambwani here, and in this weekly market outlook video, we are going to take a look at whether the pre-budget rally that so surprisingly and unexpectedly crept up on us, which I warned you in my last weekend's video, that was a probability. Now, I look back in satisfaction with the kind of work that we've done on our in-house statistical model, the IBEX. That's been fairly accurate and prescient in analyzing the market outlook, and I'll be more than happy in the year 2022 to share the output of this trading model as and when the studies that we are formulating are tried and tested and put to the paces. So the surprising rally which the numbers threw up did prove itself to have legs, and in this video backed with statistical data, I'm going to discuss with you whether the rally is likely to run ahead, and if yes, what's likely to power this rally in the coming week, and what you should watch out for any signs of threat perception of this up move. So let's plunge right in and see as the market roundup window screen on your screen shows you, the bank nifty was ideally the prima donna reason why the markets shot up, and it was the banking space that led the rally from the front, and the broader based nifty 50 relatively speaking lagged behind. Now, the US dollar remained somewhat firm, so bullion was weak, and geopolitical issues in Europe, particularly Kazakhstan and Russian gas supplies, which were choked off to Europe, kept energy prices firm. Now, friends, one of the things that I worry about in the sustainability of this pre-budget rally is rising oil and gas prices. Now, oil, as I have told you multiple times in the past, is a multiplier commodity, and it can basically trigger inflation across everything: food, footwear, milk, eggs, everything, clothing, everything, transport costs. So it's a multiplier commodity. If oil prices with gas prices rise up and the US dollar also rises in tandem, that possibly will be the biggest threat to the ongoing rally. In the week gone by, we saw oil and gas prices up, but at least the US dollar index was marginally higher. In the Indian context, the rupee actually gained against the dollar, which basically saved the day for the bulls. But if the dollar rises against the rupee and if oil and gas prices rise together, that could be a very serious threat. So this is a wild card that we are going to keep a very, very strict eye on. And do join me on my social media accounts where I track geopolitics in a 360-degree worldview manner, and I keep updating a lot of stuff. My contact coordinates of my social media accounts will come at the fag end of this video. The rupee remained firm against the dollar, which I told you is a positive because a strong rupee curbs imported inflation. 10-year benchmark bond yields surged to 20-month highs, and inflationary expectations were rising along with oil, which is why bond yields went up. Because the bond markets are expecting the RBI at some point in time in the near future to raise coupon rates. Now, the NSE market capitalization rose 2.36% on a week-on-week basis, which shows the rally was fairly broad-based. Now on your screen is the MWPL, or the market-wide position limit chart, which shows the overall open interest in the market. Now, this chart shows the open interest rising, which is routine, at least till the third week of any derivative series. Now, this month's rise in open interest in across the board in the form of MWPL needs your special attention. If the pre-budget rally is to sustain, the MWPL must rise proactively. Otherwise, I would say that the rally is suspect. Now, the index and the stock futures volumes chart on your screen, it shows a week on week rise, though the turnover was seen rising higher in the index futures segment. Do remember that this is across all three expiries, which is January, February, and March. Ideally, I would have preferred stock futures turnover to witness higher volumes than the index futures, but let's attribute this partly due to the Christmas and year-end holidays. So we are going to watch this space absolutely keenly in the coming few trading sessions in the run-up to the budget. Now on your screen is the basis chart. Now the basis is nothing but the futures premium over spot. So the basis fell on a week-on-week basis, and this is due to two reasons. Number one, time decay. Do remember 1 week of the new derivative series is already over, which means 25% of time has passed by. And secondly, selling from the bears and hedgers, people who basically take long positions in something and a short position is something. That's called hedging. So hedging and selling was seen at higher levels, which eroded the basis. Now, I update this basis chart every day on my social media pages, so do connect with me to update yourself on a day-to-day basis at the end of the day. Now, the futures premium is a rough and ready proxy for risk appetite. Now, let's go for the most reliable indicator, our in-house exclusive impetus chart, which you will not find anywhere else in the public domain. Last week, I pointed out that the Nifty had turned higher on the 31st of December, but the Bank Nifty's impetus was lagging. And I also said that a pre-budget rally would need both the Nifty 50 and the Bank Nifty index's impetus to rise together strongly. Now just note how the Bank Nifty's impetus, which is indicated by a red line, is surging strongly, while the Nifty's impetus, which is indicated as a blue line, has slid mildly on Thursday and Friday. According to me, this is a very slight and mild concern. If the coming days witnesses a rally in both indices and the impetus together, all is well and the upthrust can begin all over again. So watch this metric very, very carefully in the coming days. As and when required, I might even update my social media account with the impetus chart on a daily basis. Like I said, as and when required. Let's now get down to the footprint of various categories of all traders and see what they've been up to. Now, the FII's index futures long positions are lower at 57,238 lots, which last week was 71,972 lots. Their stock futures long positions are also marginally lower at 1,55,251 lots, which was 2,08,281 lots in the week prior. Where the DIIs are concerned, their index net shorts have come down slightly to 51,338 lots, which last week was 56,408 lots net short. Where the individual stock futures net short positions are concerned, they have also been reduced slightly to 16,47,252 lots, which in the week prior was 16,55,889 lots. So both the FIIs and the DIIs are showing a cautious hand. The DIIs have cut their shorts marginally, but they've still not come in net positive, whereas the FIIs have actually been reducing their longs. Now let's see what the prop traders have done. Now these guys are the second best to insider traders because they know they are brokers' individual trades. They know who's buying and selling, and they tend to follow suit. Now their index net shorts have gone up to 15,024 lots, which last week was a net short of 12,969 lots. Where the individual stock futures are concerned, they raised their net long positions to 19,461 lots. I'm sorry, it was a net long position of 1,94,651 lots, which last week was 1,78,435 lots. So they've been shorting the index and going long on individual stocks. That's hedging. Where the retail is concerned, now this gets interesting because the retail has been doing all the heavy lifting so far. Where the retail is concerned, their index net long positions have gone up marginally to 9,124 lots, which last week was 4,929 lots. Their individual stock futures long positions have gone up also to 12,97,350 lots, which last week was 12,69,173 lots. So the retail guys are single-handedly buying the most. Let's now come to the bond segment. According to me, the most important segment in the market because, hey, this is the fountain of all money supply to the other asset classes, right? So the 10-year benchmark bond yield shot up to 20-month highs as the rising oil and gas prices raised the specter of inflation all over again and possibly the need to raise coupon rates. I remain steadfast in my opinion that 2022 is a year of rising cost of funds. In a routine market, yields spiking like this should have seen banking stocks and by extension the bank nifty falling. But it's a pre-budget rally period and it's one of a kind. So you're seeing the correlation between benchmark yields and banking stocks has temporarily snapped. I expect this to normalize post-budget, maybe a week or two after the budget itself. That's when discerning investors may start laddering. Now, laddering is a term that bond market investors will understand immediately. I strongly suggest that you consider laddering into the bond market. Do remember that now you have the RBI's retail direct GSEC access, where you can buy RBI sovereign guaranteed bonds without any execution cost, commission and charges and without any middlemen. Yes, directly. So I suggest you start laddering for you and your family in 2022 in the bond market. And the fact that your investment is 100% central government guaranteed as long as you're buying sovereign guaranteed bonds and returns are far above bank FD rates. Now, these are a huge, huge positive. I continue to advocate that you raise allocation to the sovereign bond segment, and this avenue will provide you with higher yields as time progresses because I do expect bond yields to start rising and continue through 2022. So please do keep your powder dry. Don't invest all your money at one go. Friends, let's now go to the US dollar index, the Dixie, which is the US currency benchmark versus a global basket of currencies. This index gained 0.10% on a week on week basis. It rose on 3 out of 5 trading sessions, but the fall on Friday was large enough to eat into most of the gains made in the prior 3 gaining sessions. The price has closed below its 25-day exponential moving average, which represents a month-long holding on cost of a buyer. The fact that a peak was made in November near the 97 mark and was never tested again tells you that upsides are likely to run into overhead supply. That is actually good news for emerging markets, including India, because it cuts down our imported inflation. The 95.5 level is a near term psychological support, which, if violated on a sustained closing basis,
may see further declines opening up. Let's now move to the weekly chart. We see an inverted hammer. That means bulls tried to revive the price during the week but failed, and the price fell back to the opening levels of the week. Follow up action becomes extremely important after inverted hammers, which means the bulls have a tough task cut out for them. They must now push double hard to revive the sentiments for the US dollar index. Last week, I advocated an estimated range between 96.60 and 94.65, which held perfectly well. The coming week may see an estimated range between 96.70 on the upside and 94.75 on the downside. Watch this index extremely carefully for signs of trend determination in both commodities and the domestic bond yields.
Friends, let's now go to the Bank Nifty, which rose 6.36% on week basis, and this index rose on 4 out of 5 trading sessions and outperformed the Nifty 50 by a big wide margin. The bullish candles are big and prominent, so the buying momentum was strong. The price has overcome the previous swing high of 37,500, as you can see on your chart, and the price is also above its 25-day exponential moving average, which is approximately a month-long holding on cost of a buyer. So that existing long positions are breaking even and maybe even turning profitable. Now that's a welcome development for the bulls. Turning to the weekly chart, we see a large, powerful bullish candle that has closed above its 25-week exponential moving average, which is approximately 6-month long holding on cost of a buyer. So even the medium-term outlook is improving as well. Now, staying above the 37,500 mark on a sustained closing basis is very important if the upthrust is to sustain. Bulls will feel threat perception only if the price breaches below the 35,000 round number. In the week before last, this index was number 6 on the most volatile list, but it moved up 3 notches to number 3 because volatility on this index shot higher. I expect volatility to continue rising in the days ahead as well. I had warned you via a WhatsApp broadcast on Thursday night that Friday would be above average in terms of volatility, and that played out extremely well. If you want to be included in our free WhatsApp broadcast list, do send me an email to the number that you see up, the email ID that you see up here on the screen, and we'll get you started. Do note that this is a free kind of a feature. We don't spam you with any products or services that we market or anything at all. We don't market anything at all. And there are no stock tips, just broad market gyan, but I assure you it will keep you ahead of the rat race. Last week, I advocated an estimated range between 37,075 on the upside and 33,875 on the downside, which was exceeded by a huge, big margin on the upside because the top was at 38,135 levels on the Bank Nifty. This is only the third time in over a year and a half that our estimated range has been exceeded, and admittedly this time the range was exceeded by a big margin, the biggest so far. Now the coming week is likely to see an estimated range between 39,450 on the upside and 36,000 on the downside. I continue to advise that you trade light in view of skyrocketing volatility, which means that the range might get exceeded also again. And don't forget to maintain a very strict adherence to stop losses. Friends, I now go to the Nifty 50, which rose 2.64% on week basis. This is the most liquid and the lowest impact cost traded security on the NSE currency, the derivatives segment. The Nifty rose on 4 out of 5 trading sessions, as you can see on your chart, and the gains were large and prominent in the first half up to Wednesday. Remember, the impetus chart of the Nifty was relatively weaker than the Bank Nifty on Thursday and Friday. The price has stayed above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the bulls are in the money here. The downward sloping channel has been overcome and can well turn out to be a flag formation as long as the bulls keep the Nifty above the 17,640 levels on a sustained closing basis. Now, this flag formation is something that I pointed out to you last week as well. Now, flags are a measuring move which have an important implication for traders. Switching to the weekly chart, we see a bullish candle that has cleared the congestion zone of 17,650, which I mentioned last week, and has also closed above it. Now, clearing the 18,000 level, which is a round number and a psychological hurdle, and that too on a sustained closing basis, will be the next step to take the index higher. Price is above its 25-week exponential moving average, which is a 6-month average holding on cost of a bull. So the medium-term outlook is positive for now as well. The bulls will feel threat perception only below the 17,400 levels, so watch that space. As long as the Nifty trades above the 17,400 mark, the uptrend is intact. In the week before last, this index was number 7 on the most volatile list, but it fell 2 notches to number 9, since individual stock futures volatility rose in relative comparison. Remember, the Nifty's impetus sagged slightly on Thursday and Friday. Last week, I advocated an estimated range between 17,925 on the upside and 16,750 on the downside, which more or less held because the peak was at 17,944, only 19 points higher than my estimate. In the coming week, I see an estimated range between 18,400 on the upside and 17,200 on the downside. Do remember that volatility is at a fortnightly high, so trading light with stop losses in place is the way to go forward. Friends, the indices is done. I now come to the most popular segment of the video, where I give you 5 stocks which have high impetus, high beta, where you take small exposure, wait for large price moves, and 5 stocks which have low beta, low exposure, where you take large exposure and wait for small price moves. Why the difference in strategy? Because different traders, different mindsets, and therefore different techniques. So where the high beta, high impetus stock list is concerned, it is led by Balrampur Chini at number 1, NBCC at number 2, GNFC at number 3, Pidilite Industries number 4, and AU Bank at number 5. Now, low impetus, low beta stock list is led by Z at number 1, FSL at number 2, number 3 RBL Bank, number 4 GMR Infra, and number 5 Adani Enterprises. Friends, do remember this hierarchy of high and low beta stocks can change day to day, maybe even an hour to hour in a highly volatile market. So do connect with me on social media, where I update this data every day. We can get conversations going, help each other become better traders. Friends, I bid goodbye to you in this video, not before reminding you to subscribe to my YouTube channel if you haven't already done so. Do comment and let me know what you think of our work that we are putting up here on a week-on-week basis. Please like my video, share my video with your family and friends, and help me reach out to fellow like-minded investors and traders. Also, below the video in the description segment is a hyperlink to my playlist on Equity Masters YouTube channel, wherein I put up a couple of ideas every week. Do subscribe to that playlist as well. And there is a hyperlink to a free trading guide in PDF format from Equity Master. Do avail of that opportunity as well. Friends, I thank you for your patience and watching my video. Till we meet again in my next. This is Vijay Bhambwani. Signing off for now. Do take very good care of yourself and stay safe from the Omicron virus. Till we meet again next week. Take care. Bye bye.